The UK inflation rate has fallen to its lowest level in 3 years. This is of course good news, in the sense that 2% is better than 10 or 11%, but it does still mean that prices are rising as inflation is compounding. So the 2% growth in the cost of goods and services is on top of the other growth that we've already seen. But the 2% figure is a headline rate and can be quite misleading. It's a combination of this huge basket of goods and services, everything from door accessories, condoms and London transport. 3 completely unrelated items that often find themselves full of knobs. I'm joking. I picked them because they serve as an example of things that not everyone watching this video will buy all of the time. A large part of the UK population don't take London transport every day. When was the last time you replaced your door handles? This speaks really to how the headline rate of inflation is not the whole story. If it was, the Bank of England would be going, well, we hit 2%, our target, job done. But it's widely expected that at the Bank of England's Monetary Policy Committee meeting tomorrow, they will hold interest rates where they are. And when we look at the underlying numbers, we can see why that is the case. Here is a table breakdown of all of the main categories of inflation. Some of the largest declines on the headline rate of inflation include food, furniture and household goods. Great time to be buying doorknobs, it would appear. The big decline versus last month have all really come from the goods side of things. Just to explain this quickly, there's 2 main things that we buy, or 2 broad categories that they can be broken into. Goods, which are physical items. You give someone money and they give you an item in return, doorknobs being an example of this. And then services. This is more where you pay for the skills of someone. It is the goods-based inflation that is dragging down the number overall, as we can see here. The effect of goods on the inflation number is an overall negative force at minus 1.3%. But the service side here continues to be a big concern. Service-based inflation has barely moved yet again from 6% to 5.9%. A minor step in the right direction, but miles off where it needs to be. And this is the reason that the Bank of England is unlikely to drop rates. We all buy goods, but we also live in a service-based economy. Education, tourism, healthcare, finance, all examples of services that I think it's far more likely that us as individuals are working in or using on a day-to-day basis. You know, when was the last time you bought a doorknob? A danger of sounding like a broken record, it's service-based inflation that is the biggest concern, and it speaks to the persistent underlying inflation in the UK. Things like food and energy, which we do use all the time, are often impacted by events outside of the UK. A war or drought on the other side of the earth can affect how much we're paying for food and energy here, but service inflation is what's happening on the ground in the UK. The ONS, who compile this inflation data for this reason, strip out food and energy, booze and tobacco, as these are all volatile items, to give us core inflation. And you can see that the core numbers here are 4.2%, way off that 2% target, and falling much slower, showing that the UK has a rather sticky core inflation problem being driven by service-based inflation. This isn't new. We've been discussing this now for 2 years, pointing to this aspect in the inflation data. What is new though is who is to blame, as it's now supposedly Taylor Swift's fault. Such is the scale of her tour that when Taylor rolls into town, service-based inflation rises. I for one knew that girl was trouble when she walked in. Okay, so we know that the service-based numbers yet again have hardly budged. Honestly, I could just sit here, create an AI of me at this point that says every month, service-based inflation has not moved. These 2 lines here, especially the light blue one, is the narrative that we're given that CPI is falling and that is great. Yes, okay, but the dark blue line here is the reality felt by anyone who lives somewhere they don't own outright. The persistent rising of housing costs eating away a greater chunk of your monthly budget. I say anyone with a house they don't own outright because it's just that. It doesn't matter if you rent or own on a mortgage. Every month, more and more people are being squeezed. We can see it here. First of all, we see large declines in energy prices in a home, but this decline here is more of a reflection of energy prices went mental here and now they're coming back down again. The cost overall is still high for energy. And then the owner-occupier housing costs, the main component of which is interest on mortgages and rents, right here just keep going up. The cost of a doorknob might be falling, but the house they grant you access to is taking up an ever-increasing portion of your monthly income. There's a slight tangent here, but while researching this today, I found this stat from the Resolution Foundation. The UK has some of the oldest, smallest, inconveniently located and worst quality housing in the developed world and also pays the most for it. The increase of housing costs is really a symptom of the cure for inflation. The Bank of England has cranked interest rates to decrease demand in the economy by making borrowing more expensive. They basically take money out of your pocket because it has to be spent on things like mortgages instead. And that's really by design. But it's this sort of backwards logic that one of the leading drivers of inflation is housing costs, which is being impacted by the main tool that the Bank of England are using to combat inflation. But the problem is the service numbers are just not budging. And I don't think we'll see any relief in terms of rates coming down now until we see a meaningful decline in those service numbers. Forecasts at the minute are saying, around September for a rate cut, but it might be sooner, who knows. But just take a look at this table, which shows the long-term average Bank of England base rate stretching back to the 1600s. You'll notice that the rate we're at now is far more normal than the low rates of the previous decade or so. Today's rates, where they are right now, are more normal, and we should not expect to decline back to near zero rates. Forecasts think we might sit at around 3%, but even that is low by historical standards. In the last video we did on this, I focused a lot on the election because following the inflation data, a rather wet Rishi decided to call an election. The timing of this was interesting, and while there were a number of factors feeding into this, the fact that inflation was likely going to hit 2% today was one of them. It allows his government to take credit for inflation coming back down to 2%, even though really it's the actions of the Bank of England that are the main driver. And as I've shown you today already, the service numbers are still high anyway, so I'm not sure anyone deserves to claim that they've fixed the problem just yet. By the time the next inflation data comes out, we'll have a new government. And whoever is in charge will likely have to deal with inflation rising again. The Bank of England themselves have forecasted this for months now, and to explain why this is the case, I want to show you a little bit more about how inflation is calculated. So on screen are the UK CPI figures, the measure everyone quotes, going back to May 2023. We can see clearly this decline in the overall rate, and if we expand this out to 5 years, we get a good view of the inflation problem over this time period. Now, these measures of inflation are year on year, so they're comparing inflation in a 12-month period to the previous 12-month period. If we switch now to a month-on-month comparison, we can see a different story emerging. The reason for the decline in the overall rate this month was because this month right here has fallen out of the calculation. This is now the 13th month, it's no longer counted. And as you can see, it was the largest month of inflation in the range. So as this falls off, inflation falls overall. Okay, so what happens when these negative months fall off the data set? And what happens if we're not getting any more negative months coming into the data? We can see already that the trend here for 4 months has been positive inflation, 0.6, 0.6, 0.3, 0.3. Over the last 4 months, the average rate of inflation has been around 0.45%. I just want to point out that the month-on-month trend now is actually going the other way. If I add to these tables now the forecasted inflation rates for the next few months, you can see the problem. The forecasts are predicting a lot of positive monthly inflation figures. These forecasts actually stretch out to March 2025 as they're forecasted quarterly. But as these down months fall out of the calculation, the overall inflation number will rise again. The Bank of England thinks we'll go closer to 3%. I don't like to make predictions on inflation, I'm not smart enough, but I will predict that whoever's in charge won't be taking credit for the inflation numbers rising. And whoever the opposition is will be quick to point out that inflation has risen since the new government has taken over. Don't be fooled by it. We can see the inflation rise coming from here. It's one of the reasons that Rishi called the election. He knew that he had this window to claim that he'd fixed it before it went back up again. I hope that sheds some light on the situation and gives you a little bit more to consider than just the headline data. I cover this topic in detail, as well as many others, in my newsletter that I send out a few times a month. If you want to get involved in that, I'll leave a link below for you so you can sign up. And if this inflation data makes you feel a bit crap about life, well, I released this video yesterday, which is far more positive and upbeat, and I think it'll make you feel great if you watch it. So yeah, I'll leave that there, check it out. See you soon.